Have you ever wondered why someone can have $1 million saved for retirement and still run out of money? It's often not because they overspent, and usually not because they made terrible investments, but in many cases, it can be because of a hidden force that quietly chips away at their purchasing power every single year. I call it the invisible tax. And unlike income taxes, you never receive a bill. There's no statement telling you how much you've lost. But year after year, it silently reduces what your retirement income can actually buy. Today, I'm going to show you what this invisible tax is, why so many retirees accidentally make it worse, and what you can do to build a retirement income plan that helps keep up with it over the decades ahead. And if, as we go through this, you're wondering whether your own retirement income plan is designed to protect you from this invisible tax, there's a link in the description where you can schedule a call with me. We'll help you evaluate your current strategy and identify opportunities to improve it. So let's start with something that surprises a lot of people. Most people spend decades worrying about growing their retirement savings. Once retirement begins, the challenge changes. Now it's about maintaining your lifestyle, because retirement isn't won by having the biggest account balance. It's won by maintaining the lifestyle you want for the rest of your life. And that's exactly where inflation becomes such a powerful threat. Imagine you retire today needing $180,000 per year to comfortably support your lifestyle. If inflation averages about 3% annually, that same lifestyle could cost more than $240,000 per year in just 10 years from now. And after 20 years, it could require well over $320,000 per year to maintain the exact same standard of living. Nothing about your lifestyle changed. Groceries, healthcare, travel, utilities, home maintenance, everything simply costs more. That's why inflation acts like an invisible tax, and this invisible tax could be killing your retirement income. With inflation, your money doesn't disappear overnight. It simply buys less every year. And if you don't factor this into your retirement plan, you could end up running out of money right when you need it most. Now, here's where many retirees accidentally make things worse. After spending years watching the market fluctuate, they finally retire and decide they're done with investment risk. So they move a large portion of their retirement savings into cash or savings accounts because it feels safe. And emotionally, that decision makes perfect sense. The problem is that what's comfortable today may become very expensive tomorrow. Let's say your savings account earns 1% while inflation is running 3%. Your account balance may stay the same, but your purchasing power is actually shrinking every single year. Your bank statements won't show it, but your grocery bill will. Your insurance premiums will. Your medical expenses will. Your travel budget certainly will. That's why simply keeping investment money sitting in cash for decades can quietly become one of the biggest risks retirees face. Now, to be clear, I'm not saying cash is bad. Cash absolutely has a role. Every retirement plan should include readily available cash, money for emergencies, planned expenses, and near-term income needs. The mistake is assuming all of your retirement money should stay there indefinitely, because retirement often lasts 20, 30, or 40 years or more. Some of your money may need to continue growing simply so your future purchasing power has a chance to keep up with rising costs. Now, it's important to remember that while seeking growth is a powerful tool against rising costs, it does involve market risk. Unlike those FDIC-insured bank accounts that feel so safe, market-based strategies often involve the chance of losing principal and don't come with any guarantees. That's where thoughtful retirement income planning becomes so valuable. Instead of viewing every dollar the same, a good retirement plan assigns each dollar a job. Some money is designed for today's income, some money is designed for unexpected expenses, some money is designated for future growth, some money may be positioned to help reduce taxes over time. Each piece serves a different purpose. When everything sits in one bucket, it's very difficult to solve for all of those challenges at once. One of the biggest mistakes I see is people focusing entirely on investment returns while ignoring spending power. Because what really matters isn't whether your portfolio grows by a certain percentage. What matters is whether your income continues supporting the life you want. That's a very different question, and it usually requires a much more customized answer than simply putting everything into stocks or putting everything into savings. There's a balance. The goal isn't taking unnecessary risk. The goal isn't eliminating every bit of risk either. The goal is creating a plan that gives you confidence your income can continue supporting your lifestyle throughout changing markets, changing tax laws, and changing inflation. This is exactly what we spend a lot of time helping clients build. Now, to be clear, every family situation is different. Some people have pensions, some don't. Some rely heavily on Social Security. Others have significant investment portfolios. Some are concerned about leaving money to children. Others want to maximize retirement income while they're still alive. That's why retirement planning isn't about finding one perfect investment. It's about designing all the moving pieces to work together. Because inflation is only one of several challenges retirees face. Taxes matter, healthcare costs matter, market volatility matters, withdrawal strategies matter. When those pieces are coordinated well, retirement often becomes much more intentional and structured. So ask yourself, is this invisible tax quietly causing your spending needs to increase by 50% over the next 15 or 20 years? Would your retirement income naturally rise with it? Or would you slowly be forced to spend less, travel less, and gradually give up the retirement you worked so hard to build? Because that's how this invisible tax works. It doesn't show up all at once. It quietly reduces what your money can buy year after year without ever sending you a bill. And by the time many retirees realize what's happening, making up the difference can become much more difficult. The good news is that inflation doesn't have to catch you by surprise. With the right retirement income strategy, it's possible to build a plan that takes rising costs into account from the very beginning. That doesn't mean chasing unnecessary investment returns, and it doesn't mean trying to predict what inflation will do next. It means creating a retirement plan that's designed to adapt over time so your income has a better chance of maintaining your lifestyle as prices continue to rise. If you'd like a second opinion on your retirement income strategy, click the link in the description below and schedule a complimentary consultation with me. We'll walk through your current retirement plan, discuss your income goals, evaluate your potential risks like inflation, taxes, market volatility, and withdrawal strategies, and help you determine whether there are opportunities to improve your long-term retirement confidence. Because retirement isn't just about having enough money to retire. It's about making sure the invisible tax doesn't quietly take away the lifestyle you spent decades building. Thanks for watching, and I'll see you in the next one.